Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. The S&P 500. You've seen it on the news. You've heard investors talk about it. You've probably seen headlines saying it hit a new all-time high or dropped dramatically in a single day. But what actually is the S&P 500? Why does everyone care about it so much? And how can you, as a beginner investor, actually benefit from it? In this video, I'm going to explain everything you need to know about the S&P 500 in the simplest way possible. Let's get into it. S&P stands for Standard & Poor's, the name of the financial company that created and maintains this index. The 500 refers to the roughly 500 largest publicly traded companies in the United States. So the S&P 500 is simply a list of 500 of the biggest American companies and a way of tracking how their combined value changes over time. Think of it like a scoreboard for the American economy. When people say the market went up today, they're almost always talking about the S&P 500. It's the single most widely followed financial index in the world. The companies in the S&P 500 are household names: Apple, Microsoft, Amazon, Alphabet, the company behind Google, Meta, the company behind Facebook and Instagram, Tesla, Johnson & Johnson, Visa, JP Morgan Chase. These are some of the most powerful and valuable businesses on the planet, and they're all in the S&P 500. Together, these 500 companies represent around 80% of the total value of the entire US stock market. So when the S&P 500 moves up or down, it's telling you something meaningful about the health of the American economy, and by extension, the global economy. The S&P 500 isn't just a random list of 500 companies. It's carefully constructed and maintained according to specific rules. To be included in the S&P 500, a company must meet several criteria. It must be a US-listed company. It must have a market cap, total value of at least $14.5 billion. It must be profitable over the most recent quarter and over the most recent 4 quarters combined. And it must have sufficient trading volume and liquidity. A committee at S&P Global reviews the index regularly and makes changes when necessary, adding companies that have grown large enough to qualify and removing companies that no longer meet the criteria or have been acquired or gone private. The index is weighted by market cap, meaning larger companies have a bigger influence on the overall index value. Apple, for example, makes up around 7% of the entire S&P 500 on its own. Microsoft and Amazon are similarly large. This means when the biggest tech companies move significantly, the whole index feels it. The S&P 500 is calculated continuously during trading hours, and its value changes every second as the underlying stock prices move. Here's why the S&P 500 gets so much attention. Its long-term performance has been extraordinary. Since its creation in 1957, the S&P 500 has returned an average of roughly 10% per year before inflation, or around 7% after accounting for inflation. This includes every recession, every financial crisis, every war, every pandemic, and every period of political uncertainty over nearly 70 years. Let's put that in perspective with some numbers. If you had invested 10,000 euros into an S&P 500 index fund in 1990 and simply left it alone, by 2024, that investment would have grown to over 230,000 euros. without doing anything, without picking a single stock, without timing the market, just owning a piece of 500 American companies and letting time do the work. The S&P 500 has experienced significant crashes along the way. The dot-com crash in 2000 saw it fall over 45%. The financial crisis in 2008 saw it drop nearly 57%. The COVID crash in 2020 saw it fall 34% in just a few weeks. Every single time, it recovered. And every single time after recovering, it went on to reach new all-time highs. This doesn't guarantee future performance. Past results never do. But the historical track record of the S&P 500 is the reason it's the most trusted and widely invested index in the world. Here's the practical part. How do you actually invest in the S&P 500 as a European beginner? You can't buy the S&P 500 directly. It's an index, not a product. But you can buy ETFs that track it. These ETFs hold all 500 companies in the same proportions as the index, so your investment mirrors the index performance almost perfectly. The best S&P 500 ETF for European investors is the iShares Core S&P 500 UCITS ETF, ticker symbol CSPX. We covered this in our best ETFs video. It has a TR of just 0.7% per year, one of the lowest fees available anywhere, and over 80 billion euros in assets under management. Another popular option is the Vanguard S&P 500 UCITS ETF, ticker symbol VUSA. Similar coverage, similarly low fees, equally well established. Both are available on Trade Republic and Scalable Capital with zero commission on monthly savings plans. You can start investing in 500 of the world's most powerful companies for as little as €1 per month. One thing to be aware of as a European investor, S&P 500 ETFs are priced in US dollars. This means you have some currency risk. If the dollar weakens against the euro, your returns in euro terms will be slightly lower, even if the index itself performs well. For long-term investors, this tends to even out over time, but it's worth knowing about. This is one of the most common questions in European investing communities. Should I invest in the S&P 500 or the MSCI World? Here's the honest comparison. The S&P 500 gives you exposure to 500 US companies only. The MSCI World gives you exposure to around 100 companies across 23 developed countries, though the US still makes up about 70% of it. Historically, the S&P 500 has actually outperformed the MSCI World over most long-time periods, primarily because US tech companies have grown so dramatically. If you had invested in the S&P 500 rather than the MSCI World over the last 20 years, you would have made more money. But, and this is important, past outperformance doesn't guarantee future results. The US has dominated global markets for an unusually long period. Some periods in history have seen European, Japanese, or emerging market stocks significantly outperform the US. Diversifying globally through the MSCI World reduces your dependence on any one country continuing to dominate. For a European beginner, the honest answer is both are excellent choices. The S&P 500 has the lower fee and stronger recent track record. The MSCI World has broader diversification and lower concentration risk. Many investors simply choose one and stick with it for decades. Either approach is completely valid. What matters infinitely more than which one you choose is that you start investing stay consistent, and don't panic when markets drop. So to recap, the S&P 500 is an index tracking 500 of the largest US companies, representing around 80% of the American stock market. It has returned an average of roughly 10% per year since 1957 through every crisis and crash in that period. As a European investor, you can access it through low-cost UCITS ETFs on platforms like Trade Republic for as little as €1 per month. And while it competes closely with the MSCI World, both are excellent long-term investment choices for beginners. This video helped you understand the S&P 500. Subscribe to SimpleWealth. We post simple beginner investing content every single week. Drop your questions in the comments, and we'll see you in the next one.